but it was like something like a $30,000 a month rent for 30 years. 30 years. It's like Bobby Bonilla's contract with the Mets. Like, how did you
We've always wanted to squeeze that in.
How did you get this deal? And I'm like, and I'm asking him a million questions. I was fascinated. And I'm like, all right, you have to tell me, how much work do you put into this? Because I know my father-in-law works his ass off. He's always in his shop. He works Monday through Saturday. Saturday, he's there all day. Like, they work. And he's not just, he's run it for 50 years. I'm talking about like, he's getting under trucks and fixing brakes.
He's not checking emails.
No, his hands are always grease on him. Like, he's working with his 30, Polacks from the South Side that he's always working with. So I'm like, how much work goes into this? He's like, none. I'm like, what do you mean none? He goes, you think GE, like, he's like, you worked for GE. How many Polacks did you have running around, landlords running around your office, checking in on things? I'm like, I guess that's a good point. He's like, no, that's the lease is they handle maintenance, they handle taxes, they handle insurance. I collect rent. That's the deal we have. And I just remember for like a few weeks, I would call him and be like, how many of these do you have? Why don't you do more of this? Why don't you sell your shop and just do this? Like, it was so striking to me that probably 80% of his income was from his real estate deals, even though it probably took up 1% of his time. He didn't spend any time on this. And yet all of his money was coming in. It wasn't from his shop with all the other guys. And it just left this impression of one day I'm doing that. What's up, party people? Welcome to another episode of Let Me Speak to a Manager. Today, we are talking about my journey from retiring from the corporate space to becoming an industrial landlord. And anyone who knows me knows that I can't even change my own oil, and I am the farthest thing from being a gearhead car guy. Yet, I own several collision centers in the South, hundreds of miles away from where I live. How does a transition like this happen? You're going to have to stick around and find out. To all of our loyal listeners, thank you so much for tuning in every week. If you've not given us a 5-star review on Apple Podcasts, man, we would appreciate it. And if you are new, please hit the subscribe button wherever you listen to podcasts and turn on those notifications. Let's ride.
You're listening to Let Me Speak to a Manager with Frank Cava and Ian Matthews.
What a crock of shit.
Yeah, that was hot mic, Sam.
You can't say God on the air.
Don't worry, nobody's listening anyway.
Do it live! I'll write it and we'll do it live!
Frankie!
Ian, you son of a bitch!
Happy Friday, man. Here we are recording. We are some hardworking dudes. We tried to start this thing off. We'll dabble a little in the podcast. Now we're just grinding. This is like our third episode this week, grinding.
It is. It's incredible. I mean, our dozens and dozens of loyal listeners are so fortunate that we work so hard at this.
We are overwhelming people with incredible content, largely because you and I are about to go on vacation for weeks and we don't feel like recording while I'm in Greece or wherever the hell you're going to be. You're not going to be more fun because you have a baby. So what the hell is the point of going somewhere fun with a baby?
I'm going where there's family who thinks my child is insanely incredible.
That's great because you can just give the baby.
It's not going to give. It's a bounce pass. A bounce pass is delivered with some malice. When you deliver a baby to somebody, it's like, boom, like, hey, there it is, coming in hot. My wife and I are heading to the bar. Hello.
And then you're out. You're out. You are out.
You are right. He's adorable. We'll see you in 4 hours.
So Frank, what is so important that our overinflated sense of self-worth thinks that we needed to record a third podcast this week?
I mean, Ian, I got a haircut for the event, but I didn't think it was so important that I should trim my beard. Your wife keeps texting me that your hair is gray and I'm trying to make you feel better by putting my beard out there.
For the record, you're really showing me up, you son of a bitch. So every time Jenny sees Frank on Facebook, she's like, why doesn't Frank have gray hair? Like, what? you're like almost all gray. You look like a grandpa next to him. What is he coloring that? And I'm like, I don't think he's coloring it. He's just Italian. Look at his beard. There's gray everywhere. If he was going to color his hair, he'd color his beard too, because that's more, you could see it. She's like, well, why are you so gray? I'm like, I don't know, Jenny. I don't know. He had a good 10-year run out of the corporate world where I was living it hard. So maybe now I catch up with him.
Hereditary, dude. I got like 2 extra belt loops. But what we're going to talk about today is, so we did a podcast a couple weeks ago about the deal that we're putting into fruition now, right? We got a couple of documents we have to finish, but we have verbally raised the $4.5 million that we were claiming we were going to raise for this syndication deal. It was kind of a bond offering. It's a little different than syndication, but it's in my local market in Richmond. And Ian just sold a collision shop in Georgia, and we're going to go through why he did it, like got into it. So what I want to do is I want to kind of set my recollection of what happened and how you got into this. And then I'll let you kind of correct the story and tell it your way, and then we'll kind of walk through it. So I left NVR in 2009. I remember Ian and I were having conversations with each other in December of 2017. And I remember Ian had a really big thing happening. He had to, he was going to resign. He wanted to resign in December of 2017 and talk to his boss about it. And he wanted to make sure that, you know, on paper, he was an employee at least past midnight on January 1st, because it made a big difference in you know, stock options and things like that. So I remember, like, I was actually in California. Ian called me at like 7 a.m. Eastern time. It was like 4 a.m. and I was already awake, and we talked really quickly. And then he was in his meeting. I left him a really cool message and just said, whenever anybody I know leaves corporate, I leave some version of a message, you know, if there's one of my friends, with congratulations on leaving that behind. Welcome to the rest of your life. But then Ian had a problem. He had money. He needed to do something with it, and keeping it in a Wells Fargo account isn't prudent. So as Ian started to kind of look around in 2018 of where to put money, he started looking at different asset classes. He's more invested in the stock market than I am. I think you were still active there, but you kind of landed on collision centers. And my recollection is you picked the asset class because it was safe. It had A+ tenants. It kind of was in a sweet spot, if you will, of pricing and you can talk about that. And you kind of were looking around, and I remember you and I talking a bit as you were driving to your first one, like with 1,000 questions and kind of getting into it. And then you had to ask yourself, am I going to do it or not? So I think that's my recollection. Where do you want to take it?
Yeah, I think all that's right. So I, prior to leaving NVR, my whole sum of real estate ownership was 3 different houses that Jenny and I bought, right? So condo in DC, a townhome in Chicago, you know, and then we were living out in Vienna. We had purchased a home. So, you know, I had real estate experience, residential, just because I worked for a home builder for 13 years, but I never really considered myself an investor. All of my assets to that point had always been in the stock market. And all of my wealth had been tied really to my executive stock options. So it was kind of one of those deals. I don't know, Frank, do you remember where you were when you became a millionaire? Do you remember like the first time you noticed it?
Yeah, I actively used to track it. So I was 27 years old, and it was a combination of things. I worked really hard to save money. NVR stock had gone bananas, and was like my retirement account was right around $500,000, and I had enough equity in 2 real estate deals where on paper I was a millionaire.
Yeah, so a lot of it's paper. So I was well over $1 million the first time I ever noticed it. I wasn't actively tracking it. I wasn't actively paying attention to it, because, you know, you look at equity in your real estate, you look at equity and stock options. But what's interesting is from the first time I noticed that I was $1 million net worth until when I was 5 million net worth was like 3 years, 4 years. It was super fast. And a big reason for that is the manner in which I worked And, being an executive in a company, that's how I earn money. I, I had stock options, and I had a lot of them. I'd grown really fast in the company in a 5-year period, to where every year I was given another region to take over, another branch to take over. And every time that happened, I'd be given more stock options, 500 stock options, 1,000 stock options, 2,000. My last promotion was 5,000 stock options. So the way they work in a big corporation, if you don't know how stock options work, you get them at a certain hit price. And then anything that the company does above that is what you make on it. So what was crazy with NVR, so for NVR, I got to NVR, it was like a $600 share.
Let me do something. I want to say two things real quick. The first thing I want to say is this: I dated a girl in college whose family had a bunch of money, and I showed up. I'm 22 years old, 21, and some relative or aunt was like talking to her and me, and she said something along the lines of, well, that's back when $1 million was a lot of money. And I was piss broke. I had like $1,700 in the bank, and I drove a 10-year-old car, and I was like, it still is a lot of money. But in 1998, I graduated from college and went to work for the same company. The stock was trading when I joined the company at $33 a share. And I think this is relevant because it shows the whole roller coaster ride for the stock. And then Ian and I got on and off at different points. When I joined in 1998, it was $33 a share. Everyone was shocked that it was $33 a share, because most of the people had worked there through the last correction and the bankruptcy, where the stock was trading at like less than $1. So like there's people who own shares that were trading at sub $1 that then had it at 30. And then what I did, and we've talked about this before, I'll say it very quickly. My first bonus check, I bought as much Ryan Home stock, NVR stock, as I possibly could. I was invested through ESOP and everything else, but I was like, I want to do something with this. And I bought it for $35, somewhere between 35 and $40 a share. And I sold it at $8.50 a share. It was worth like 80 something grand. And that's how I made a down payment to buy my first flip. But from 1998 through when you joined the company, Ian, the stock had run from $33 a share to where was it when you started?
When I started, it was around $600.
Okay, keep going.
So it was around $600. And I think a little bit different is Frank and I are the same age, but when I started at MVR, Frank had kind of been grinding his way up in the company. I came in at an executive level. So my first day in 2005, I had 1,000 stock options, and then I got another 1,000 6 months later. So I had 2,000 stock options at a hit price of $600 right out of the gate. And so the way stock options work, you can't just sell them. They're called handcuffs for a reason. They're meant to keep an executive from leaving and going anywhere. And so stock went up to $900, then it fell, and it was kind of crap for 3 or 4 years. But over 10 years, I had very good mentors at NVR that taught me, don't sell these things as soon as they're worth money, hold them for 10 years. That's what you're allowed to hold them for. So by the time they got, to 2015, I had these at 600 and the price is maybe 1,600. That 2,000, you multiply by 1,000 in growth. So you've got a couple $1 million there. And along the lines, every year or two, I'd been given more stock options because of promotions, bigger titles, bigger jobs. So I was always getting these 1,000, 2,000 options. And every 2 or 3 years, I would look and say, I'm coming up on 10 years. So I have to sell these now. And so that's why my net worth rapidly went from $1 million to 5 million. And then the last 3 years I was there, it more than doubled again. And that's because the MVR stock price went from $1,700 to $3,500. It doubled in almost a year. It felt like that happened in 2016 and 17. So I'm looking at how much money I could cash. And so the way it works with stock options, you don't have to wait for anyone to tell you you can take it. You can give yourself a bonus anytime you want. I could have sold at any time. I could have sold 100 shares that were in the money, 2,000, and just taken myself a quick $200,000 bonus anytime I wanted. And literally the money, it's like any other bonus. It's taxed. Tax is taken out of it, and then the money hits just like a pay deposit. So I got to a place where I'm looking at it and I'm going, holy crap, like I had all of this stuff vesting on the first, that if you'd have told me 10 years before when I'd started, 13 years before when I started, I would have 8 figures that I could take away, would I keep working? I was 41 and I was like, no, I would not keep working, especially a job I wasn't happy with. So the money, the stock going up is partly what drove my behaviors the last 6 months of NVR, of not giving a shit anymore about anything that was happening at NVR, because I was like, you know, my God, I don't need to work at a company anymore. I can retire. So I did. So I retired, and then I had.
Hold on one second. Let's talk about this. So there's a lot of people who are in Ian's position who didn't retire or couldn't retire. And I think one of the things that we must say, and I think this is critical, I think the reason that Ian was able to do what he did is he didn't sell the stock as soon as it vested. There's a vesting period and there's an expiration period. Ian was humble, which is hard for us to say, but he was humble enough to say, I am not as good at managing my money as Paul Seville is at managing this money. And he rode the stock options out. And Ian and I will both joke, we see people, we know the vesting date of stocks and we know the bonus date that people get their bonus checks, and people are buying beach houses or people are buying really expensive cars, but they're not buying assets and they're not letting that asset get the most of its possible value. And what Ian did is he sacrificed immediate gain for long-term wealth by holding these things and allowing them to increase even more in value. And he said a second ago, like double, like almost in a year. Had he vested those, that it would have been gone. His value skyrocketed because of his patience.
Yeah, so I think that's a really good point. So our CEO once told me that something crazy like 80% of people with options sold within a month of their vesting date, like, which meant you sold after 4 years and didn't hold them for 6 years where they could grow tax-free. So at any given point after 2012, Frank, I could have sold 200 shares at any time and made myself a couple $100,000 and ran out and bought a Lamborghini. At any point, I could have done something stupid like that. I could have went and sold a bunch more and bought a bigger house, a better house. But in all those years, I was driving around in a Jeep Grand Cherokee that was 5, 6 years old. I wasn't spending any of it. I was just holding it as long as I could, because I never wanted to be the guy that worked until he was 60 in a corporation. I just never wanted that. I wasn't interested in it. And I looked at it and I thought, man, if I would just hold this stuff, and let it grow tax-free and just live more humbly over those 10 years, I won't have to keep working here. So I think that's exactly right. I think the majority of people that had stock options, now I had more than most. When I left, I was probably a top 10 executive in the company, at least options wise. I was in that mix. When options were given out, I was given much more. So my last promotion, getting 5,000 stock options when the price was around 2,000 was crazy. That's a $10 million option package that I was given at that point. But for me, I think holding it was the best, by far the smartest investment move I ever did, was being disciplined enough to not take a bonus whenever I felt like the urge to go spend money, and holding all of that stuff as long as I possibly could, so that when it was time to take a really big bonus, I left with an exit that set me up for the rest of my life if I wanted it.
So it's funny now that Ian and I do this podcast together, I think the cat's out of the bag that we're friends. There's a bunch of people at NVR that like, I didn't even know you guys knew each other. But like, one of the questions I hear regularly is, I can't believe Ian left so much money on the table. And it depends on who says it to me. Usually I just go, yeah, I mean, he had, I just dismiss it. But if it's a smarter person or somebody who I think deserves to hear it, I'll always ask them, like, did you ever ask him why? Did you realize what he did? Did you understand that he didn't cash him immediately? He let him, he didn't get one set of options because he didn't cash him at year 4, year 5. He essentially got 2 sets of options, and he wrote them And he didn't need to wait for these other handcuffs to mature because he was patient enough to just do it once. And I think as an investor, what you and I are really good at collectively, and we do it in individual ways most of the time, is we realize you don't make your money. You don't make your money when you sell. You're making money when you purchase. You realize it when you sell. And what you realize is, hey, I've got these incredible options to purchase is when they were vested to you. And I can realize it later. It's the same thing that we're doing with the deal we're doing now in Richmond. I think that's it's worth slowing down and noting.
Yeah. So I get that a lot. And I've had this conversation with David Moeller a number of times because he knows how much I left behind. Anyone who's ever retired as a senior executive from a big corporation left a lot of money on the table. This is the nature of stock options.
How they do it.
As you are working and doing a good job, the company keeps giving you options that are not vested, that you have to wait several years. So anyone who's ever retired, my mentor, Bill Inman, right? Bill Inman retired when he was 60, something like that. He's the founder of the finance business for NVR, probably worth 150 million when he left, $200 million when he left. He left 50 to 80 million dollars of unvested options. If he'd have stayed another 5-6 years to get that next run, how many options he had. So anyone who's retired or left NVR left a lot of money on the table. Like saying I did, okay, great. Yes. But if I waited till I'm 60, I'll still be leaving at any time, 45, age of 50, age of 55. Anytime I would leave, I would be leaving more and more and more and more on the table. So this game never ends. This rat race,
the cycle never ends.
The golden handcuffs never end. Frank, if I would have waited 5 more years, I would have made a ton more money. But I would have also had a ton more money of unvested that people would be saying, I can't believe he left that much. And if I'd have waited 10 more years, it would be even bigger. So it snowballs. So I had to come to grips with how much is enough. This was a very hard question for me to answer because I'm young and my family's young. So I'm not 65. I'm not like, hey, kids are out of college, taking care of everything. The challenge for me was, how does a family of 4 continue to live the way we do and have everything we want? I might live 60 more years. So if I'm leaving a corporation, I'm leaving that much money. Am I sure what I'm taking away is doing good? Because yes, I could take 8 figures away in that January of 2018. I left 20 some million dollars of unvested options that I would have had to have waited 5 years to get it. But $20 million of real income, bonus money, I would have had to waited 5 more years to get it. So I think a lot of people looked at it and said, you couldn't just grind it out 5 more years. But Frankie, to me, it was like, that will never end. Then I'm 46 and people are going to be like, you can't just wait 5 more years to get that next 40 million. And when does that end? And how much of my life, 5 years, 10 years, a decade is a long time. And I think this is important, Frank. Madison was 5, IJ was 8. So the 10 years you're talking about to get that money is the sweet spot of raising kids, right? Madison was 5. She's, you're past all the diapers, the toddlers, the terrible 3s. She's just a cool little kid to hang out with. So is IJ. They're both in prime sports years. So I got to give up that 10 years to get just so I can say I have more money. So the question for me had to be, how much was enough to live really comfortably? And will it not, like the irrational fear I had was this big nest egg is just going to dwindle down to nothing by the time I'm 50 and I'm going to be putting a resume together and interviewing, which in hindsight was completely irrational and stupid. And you had to tell me that multiple times, but I was like, I'm going to spend all my money. And you'd be like, do you know how hard it is to spend all that, the money you have? But it would freak me out. But that drove a lot of my decision.
So let's calibrate this for a minute. Before you quit, the smart things you did is you levered your GE career into an executive's position with a company that valued you from day one and gave you an executive salary with some options. The second thing you did that was really smart is you understood the options. I had options. I didn't understand them nearly as well as you. And because I grinded from the bottom up, my option package was a fraction of your options package. Number three, you waited and you were patient. Then number four, as you were deciding to make this exit, you kind of weighed your options and your choices. And again, I remember I was in California while you were making this decision. I had my feet in the Pacific Ocean, watching the sunset. You were coming home from work. You're on the highway. We were talking, and you had just talked to Inman, and Inman had told you, you'd said how much you were going to have. Talk about that conversation you had to him, and when you decided it's gone, I'm letting this ship set sail.
So I wish I had the guts to talk to him before I quit. I didn't. I didn't have the guts. So again, he's my mentor, but he's also close friends with the chairman and the CEO. And I guess I was nervous that he might talk to them, or I kind of wanted it to just be wrapped up. But he was the hardest conversation I had to have because he really had taken a huge liking to me, and he was a mentor. And he didn't leave at 41. He stayed till he was 60. So I told him how much money it was, and he was like, that's the smartest thing I ever heard in my life. He's like, he said something, he's like, I'm worth so and so. He goes, I don't spend any of it. It sits in, like, most of it's in a checking account, not even
he has 50 million in treasuries. We were talking about this.
I'm just going to give it to my kids. Like, I don't want to buy another house. I don't travel that much. And he kind of went through, and he goes, the one thing I can't have back is when we went through the bankruptcy, I never saw my girls, never saw them. He's like, so, he goes, if you're really leaving to go spend more time with your family, this is great. He's like, but don't let something else consume you. Go be with your family if you're going to leave this, because you're not going to find a better corporate gig than MBR. And I think one thing you just mentioned 5 things that I did. I would put number 1, if I traded a company whose stock did not have a great future for one that was going like a rocket ship. So I think that's number 1. I decided if I'm going to be an executive and stock options is how I'm going to get paid, I need to go to a place that's small, not GE, which is like a third world country. It's huge. I need to go to a small place that could just blow up, that could triple, quadruple, 5x, in 10, 15 years, because then my options will be worth so much. My options would have been worth 0 for a decade at GE, because GE stock went from 60 to 40 to 30 to 20. I think it's still trading at 13. They're worthless. Those are worthless stock options. So great job. You're an executive. What the hell does that mean? You're just making a salary and bonus. You're not getting paid any equity.
And what you did that was really smart, which is different than how I did it, you rose up the ranks at GE. They weren't going to reward you with the same options package that you got by leaving, coming to a place where that was one of the enticements. So it was in one of my favorite quotes from Gulliver's Travels, in the land of the blind, the one-eyed man is king. You found a place where you were valued, you got them, you wrote them. It's an awesome story. But what's different than most people is you maximize the value, and then you said, all right, enough is enough. So let's now fast forward. It's January 1st. You're unemployed. You have a bank account with 2 commas worth of money in it. And you're telling everybody you're retired, where we've discussed on this podcast, that was basically just a way to buy time. But what you started to do is, that's when human nature creeps in. I'm bored. I'm used to waking up early and having something to do, and you don't. And you're like, I also have this money, which is a blessing, but also it's a curse. So you start thinking about what to do with it. And that is the year that you and I went to Omaha, and we went to a couple of investor conferences together, and we went and saw, and then you did it independent of me with some others. So you started kind of looking around a little bit. So what led you to collision shops and industrial real estate?
So, after like a week of everyone calling and saying, I'm so surprised and we're going to miss you. And, thanks. And, you had just, 100 phone calls like that happen when you leave a big company. Then you quit getting calls, and, that's third week, really. The first 2 weeks, you get lots of calls. They come in layers, like the people closest to you call first, and then kind of the mid-level, and then the people that weren't sure they knew you, but they still wanted to say something nice, they call. But then that third week, you're looking at checking your email at 11 a.m. and you haven't received one, and you're like, holy shit, like nothing is going on here. And then you start second guessing. I start second guessing myself for sure. What did you do? And then all the voices start coming in your head. All the people that said, why not just wait 5 more years? You should have waited 5 more years. Is this enough money? What am I going to do with it? And I started getting phone calls from people I used to work with that wanted me to come back into an executive role, a corporate role, bigger positions. And it was like, no, I traded that. I'm not going back into that because I'm not going to find something better than the options that I had somewhere else. So I'm not doing that. So I within days, I was already fretting that all my money was going to go away and I need to find something to put it in. And I didn't want to go put all that money into the stock market because to me, you're just speculating. That felt like it was just speculating our future, our family's future. So I kept a chunk in the stock market, but I didn't want most of it in there. I needed cash. I needed to spin off. Since 1999, I'd had a salary that hit twice a week, in NBR, it's once a month. But I'd had a salary. I'd had a monthly salary that my family lived off of, and now I didn't have one. I just had a bunch of money. And so I needed, for my own sanity, I needed to see a direct deposit hitting an account, and I needed to figure out how I was going to make that happen.
So I want to say something here for a second. My wife and I were having a conversation last night, and I now have a personal trainer who meets me at the house every day at 6:15. I don't have a meet me earlier. In my 20s or my 30s, I would have had it at like 5 or 5:30, and I would have traveled somewhere, and I never showed up. And the reason is I was like, I'll just pay for it. It's too inconvenient. But what I've learned is how I work as a human being. I understand what works for me and what doesn't. And I have some boundaries. If I go to bed at 2 a.m, I can get up at 6. 5:45 seems daunting. 6 doesn't. So meeting at 6:15, I can always get up for it. In addition to that, if the person's parked in front of my house or on their way, I don't want to cancel because those are going to work against the grain of who I am. So I've set this up, and for 3 months, I've not missed a day because I set it up to win for me. Now, it might be the wrong reasoning for you, but it's the right reasoning for me. What you just said is this is your personal trainer story. Hey, as Ian, this gives me comfort, and that's important. So what guides a lot of these decisions is being smart enough to understand what success or what feels comfortable that allows you to live. And I have noticed in my life, very few people have figured that out for themselves. And a lot of people want to dictate to me terms. And I look at them and bluntly, I'm like, well, you're less successful, you're less financially wealthy. And frankly, I don't want to follow that. So I think having the stones to say, this is how it's going to need to be for me, and then setting that up is crucial.
Yeah. So long before I decided I was going to leave NBR, I knew I was coming into money. So I knew I would need to do something with this money. And I knew I didn't want to just have a ton of money sitting in NBR. I needed to diversify, and I wanted to have some extra. And I knew the asset class I was excited about was the same as my father-in-law's asset class, which was industrial real estate. I really wanted a property in the industrial space somehow. And there's a couple of reasons for that. One, I had a pretty good understanding of the industrial space because of my background, starting with GE. I spent 5 years doing nothing but walking around steel mills and processing plants and automotives and paper mills. And now those big guys, they own the land because the land is worth a lot less than the equipment and the buildings that go on it. So it'd be hard if a landlord kicked them out for them to just relocate a blast furnace and a kiln, and so they own it. But I kind of felt comfortable around that industrial space. The industrial world, I like it. My dad's a steel worker, so I'm comfortable around those kind of properties, probably more even than resi or office. I didn't want office space at all, even before COVID. I just didn't love I never loved the asset class. I felt like that's always getting overbuilt. It's always boom bust. I've seen that happen multiple times, and I did sense that with technology there'd be less and less people working in offices. So for me, it was, and I thought about residential. Frank and I talked about a number of different things that we could do together, but but at the time, for me, I wanted to go after and do a deal like my father-in-law had done, and he owns some equipment rental companies. He owns a number of trucking yards, and he's a phenomenal guy. I think I've talked about him before on this, but he's Polish immigrant, right off the boat, bootstrapped himself. You know, didn't even speak English and started his own company. He left. You know, he's got stones like you wouldn't believe. But over the years, he built a very successful trucking repair business, and by opportunity, pieces of land would come available to him at a really good price because he would know someone who was either moving out of town or, you know, selling it. And so he acquired some of it. And I remember this was like 10 years probably before I left MBR. So this was, you know, probably 2007. He just took me in Chicago to a facility, and it was a GE facility. It had a big, you know, meatball on it. And he's like, look at this. And I'm like, oh, wow, it's nice, big GE trucking facility. This must be the capital business. He said, yeah, that's exactly who it is. He's like, I own this. And, you know, I didn't understand what that meant, you know, and I said, what do you mean you own this? It's GE's, it says GE. He goes, oh, GE's not in the land business. They, you know, I'm their landlord. We have a lease. And it wasn't resonating because this, Frankie, this was like a 6-acre plot, paved, trucks coming in and out, electronic gate, like it's a GE trucking facility, you know, a depot coming in and out. And I'm like, there's no way you own this. He's like, I did. He's like, I bought it when it was just gravel. GE came to me and said, we like the location. It's on a frontage road. We need a trucking center. And they contacted me and they said, if you'll build an office, if you'll pave it, if you will put an electronic fence in. And so all this came out to, I don't know, $700,000-$800,000 he had to spend on it. We'll do a lease with you. And I was like, how long's the lease? And he was like, 30 years. And I'm like, what? And then he told me the rent. And I'm doing the math in my head on this deal that my father-in-law, who's like the most humble guy, never talks about these kind of things, but it was like something like a $30,000 a month rent for 30 years. 30 years. It's like Bobby Bonilla's contract with the Mets. Like, how did you
We've always wanted to squeeze that in.
how did you get this deal? And I'm like, and I'm asking him a million questions. I was fascinated. And I'm like, all right, you have to tell me, how much work do you put into this? Because I know my father-in-law works his ass off. He's always in his shop. He works Monday through Saturday. Saturday, he's there all day. Like, they work. And he's not just, you know, he's run it for 50 years. I'm talking about like, he's getting under trucks and fixing brakes.
He's not checking emails.
No, his hands are always grease
Right.
on him. Like, he's working with his 30, you know, Polacks from the South Side that he's always working with. So I'm like, how much work goes into this? He's like, none. I'm like, what do you mean none? He goes, you think GE, like, he's like, you worked for GE. How many Polacks did you have running around, landlords running around your office, checking in on things? I'm like, I guess that's a good point. He's like, no, that's the lease is they handle maintenance, they handle taxes, they handle insurance. I collect rent. That's the deal we have. And I just remember for like a few weeks, I would call him and be like, how many of these do you have? Why don't you do more of this? Why don't you sell your shop and just do this? Like, it was so striking to me that probably 80% of his income was from his real estate deals, even though it probably took up 1% of his time. He didn't spend any time on this, and yet all of his money was coming in. It wasn't from his shop with all the other guys. And it just left this impression of, one day I'm doing that. I'm going to get a big property, one tenant, and that's it. And I'm going to collect that rent. So I was sure that's what I wanted to do one day. It accelerated when NVR stock went up and I decided to leave and retire.
So let's just jump into it. How'd you find your first deal?
So I knew I wanted to go south. I knew I wanted to go where it was warm. There's a couple of reasons for that. One, if you have an industrial property, I did a bunch of research. So I listened to just hundreds of hours of podcasts on this world. I found a number of good ones, industrial podcasts, but I listened to as many real estate podcasts as I could. And the more I dug into it, the more I realized that the one thing you're kind of responsible for in all of these leases is the roof. And I didn't want snow on my roof. I didn't want like harsh weather messing with the property. I wanted it to be warm. And the other reason I liked the South is that's where NVR was growing most aggressively. And NVR is very smart about how they acquire land. And so I wanted to be where economic growth was. In the South, it's much more friendly to be a landlord down there than places like Chicago or New York, or let's be real, liberal states. They're tough on landlords, and the taxes are much higher in those places. So low taxes, great economies, great growth of employment, great growth of economic engines down there, low taxes, and friendly laws for landlords. So I knew I was going south, and Initially I went, this was like 3 days after leaving NVR. I was so bored. I was driving Jenny crazy. If you're ever going to leave a company, don't leave in January because the weather sucks.
If you live in a place where it's cold.
Yes. There was nowhere to go. There was nothing to do. I couldn't really be outside. So I was just kicking around the house, driving Jenny crazy. So I built a list of 100 banks in the South. And I spent a whole day where I just did the research, got the name of the highest level person I could find in these community banks, small banks. And I got that from you. You told me, don't dick around with Wells Fargo and Bank of America.
That's right.
Don't even bother calling them.
And for those of you listening, that's how I did it. Like I literally find local banks that have a commercial division. You find that person, you can find it on the internet, and you call them. And those are the people who ultimately lend.
So I got that from you and I loved it. And I'm like, okay, this is something I can control. This is something I can do. I'm going to make a list and I'm going to make phone calls. So I went to a coffee shop and I spent 3 days cold calling presidents of banks. And my initial thought was, I want to get to the distressed debt departments. I wanted to buy some bad debt and then own the land, see if I go fix it up.
Explain what that is.
So bad debt is, I wanted to see if any of these banks had tenants in the industrial space that weren't making their payments. So if that's the case, a lot of times these banks are looking to get those assets off their books. But the more I found out.
What year did you quit? 2008, January. You quit January of 2018, right?
That's right. Yeah.
Strong economy. These banks don't have tons of bad stuff, and if they do have some bad paper on their books, they're going to sell it to somebody who already has a relationship with them. Like it was very different in 2008, but in 2018, that's not the place to be.
100%. So I talked to all these banks. I called all of them. I talked to as many, and after like 30 of them, I realized like no one has distressed debt. No one has distressed debt. These guys would laugh and be like, if it's distressed, people just sell. Prices are going up. When prices are going up, there is no distressed debt. There's no default.
That's right.
It's the old Warren Buffett, you don't know who's swimming naked until the tide goes out. The tide was high, so no one was being exposed for being naked. So, but what I did learn from all these folks, I would then ask them questions about industrial and what do you guys lend on industrial? How do you lend? What are the terms? If I find a deal in your yard, would you lend to me? And that would keep them on the phone talking to me. And I got some names of people that they knew that had been borrowing from them that were in the industrial space. And one thing that kept coming up was collision centers when I was making these phone calls. So I was calling Frankie, South Carolina, North Carolina, Georgia, Texas, Mississippi. I was calling Florida, pretty much anywhere in the South. I was open to wherever. And I got some good leads in Florida and Georgia. One of them was a guy who had been working with Gerber Collision, which Gerber Collision is a publicly traded collision center. They have probably 600-700 collision centers. You can buy their stock, on the open market. Big billion-plus-dollar company. And this guy would go and convince owners of collision centers to sell out. So some guy who's 70 and started his collision center 50 years ago and wasn't making the money he used to, and they would convince him to sell. Then he would do what Ted did. He would go in, put money into the, build a new paint shop, update the office, make it look nice, and then do a deal with Gerber for 10-year lease, 15-year lease. And so I ended up talking with this guy, and then I talked to the realtor he works with, which is Marcus and Millichap, and they were selling a property in Hinesville, Georgia. And that's not the first one I found. I actually bid on a couple that I lost. One I almost had, but I was getting my ass kicked on a few of the bigger properties. One time a New York firm came in and bid cash without doing any due diligence. Like they said, we'll waive due diligence, which means we won't do an environmental study. We won't and a guy like me, that
Too much risk for someone like us.
That could kill me. New York can go do it. So anyway, found this Gerber one, bid on it, went in as aggressive as I could. Hinesville, Georgia, kind of in the middle of nowhere a little bit. There's a big Army base there, but it's about an hour away from Savannah, Georgia. So I'd never been there. So that's when I talked to you. I drove down, looked at it, beautiful building, beautiful property, really close to, to the Army base that's there. And I got to talk to the shop manager for 2 hours. He was the nicest guy. Went to lunch and I just picked his brain about how fast they were growing, what was going on. And I learned a lot about the economics of the collision center business. So I learned about when a big guy like Gerber comes in, they have relationships with insurance companies. So when they come in, they can immediately become the preferred person. So let's say, Frankie, you're in the military, you get in a car accident, you probably have USAA. That's like all the military has USAA or Navy Fed, right? Car insurance. Well, you get in a car accident, you call the number on your insurance card and they say, there's a Gerber a block away. No one has a guy anymore. No one's like, oh, I got a guy that does my collision work. No, you don't. Like, you call your insurance company, they give you 2 places to go to. And if you're preferred, you go in there. So these big collision shops, they go and buy out the little mom and pops, and they double or triple their revenue from cars just by their insurance carriers right away. So I learned about how strong of a shop this was and how great of a location. And this guy gave me all their revenue number. Like, he gave me stuff he shouldn't have been giving me. Gave me their revenue, their sales growth, their pace, their expansion plans. I asked him a million questions. Would you ever move from this place? Would you ever outgrow this place? And he's like, no, look, there's a car dealership across. There were like 4 car dealerships. And I learned how important that is to have a car dealerships near you for a collision center. So I just learned a lot about the business.
So you've owned Apple stock. Did you have a similar conversation with Steve Jobs when he was alive about Apple stock?
Did not go to an Apple store and talk to the manager to see how things were going.
So I think it suffices to say, you started to learn about the asset class. You realized there was safety. There's making money and then there's keeping money. We're in the keeping money phase here because of where Ian is. So risking it, you can't do that. So what he did instead is he found, not insider information is the wrong thing, but he found a lot of incredibly valuable, pertinent, relevant information. He found an asset class that he could control. You kind of glossed over the sweet spot. The sweet spot, you were saying New York would come in and just poach these huge deals. But like, talk to me a little bit about the pricing and the like where we landed on the numbers here.
First deal I did was a $3 million property. And what I learned was this like $2 to $4 million range is a real sweet spot. So 2 to 4 million, the reason why it's a sweet spot, it's too expensive for just a retail investor to come in and scoop it up. And the reason why it's too expensive, they can't get debt for a $3 million property unless you have a track record as an operator of an industrial property. So you can't go in without a huge down payment, right? So to do a $3 million deal, if you were just a retail guy trying to grab it, you'd have to put 50, 60% down without a track record. And that wipes out, most people don't have $1.5 million to go put down on a deal. And it's also not big enough to draw the attention of a lot of New York REITs. So real estate investment trusts, they'll come in and gobble things up, but they're normally looking for $5 to $10 million deals to really make an impact on their overall portfolio. So a little shop in the middle of Georgia, in Hinesville, Georgia, isn't going to draw New York's attention to go bid on it and bid the price up to where I didn't want it anymore. And so by going through all this, Frankie, the beauty of this one is Gerber was publicly traded. So there was just gobs of information on the internet. I could go look up all of their investor presentations. I could read their annual reports from the last 5 years. Like, there are so many things they have to talk about. And I was worried about, what if there's autonomous cars? That was probably my biggest worry, is will these go away if Musk figures out how to put cars on the roads that never crash? But the more I researched that, it felt like that's 15, 20 years away. The average car on the road is like 11 years old. So I learned so much about automobiles, cars, the collision business, and I loved it. I just loved the business.
So what you did here is, I would say, your risk evaluation. And because you had a publicly traded tenant on the back end, your risk evaluation got really granular quickly about, okay, this is a publicly traded company. That's not a risk. There's a lot of positives. And then the risk came down to the cars itself. Was there anything else you kind of looked at on the risk side?
Yes. So I needed to understand what kind of leases these were. So for me, it needed to be similar. I was looking for the model of one, it's in Hinesville. So this is a 7-hour drive from me, just 7-8 hours drive in the middle of nowhere, Georgia. I couldn't have a lease where I was getting a call from a shop manager at 9 a.m. saying our plumbing's a mess, like, get down here. Like, I needed a lease that they would handle that themselves. That's what they needed, because I was not going to be able to get in my truck on a whim and just drive down to Georgia. I was buying something very far away from me. And my goal was to never visit the place, not see it. Like, it's an asset. Like you said, I don't go to Cupertino once a year because I own Apple stock. I just own Apple stock and they give me returns. So that was really important to me, that the lease was a true triple net. They pay insurances, they pay insurance, they pay taxes, they handle the maintenance, aside from a couple of small carve outs like the roof. That I felt very comfortable with, given that this was a brand new building that was just built there. So that to me was a big one. And then the economics of it. So when I left NVR, I had a salary of, I don't know, $235,000 salary. And then my bonus was 100% of the salary. So I could make another $235,000. In any given year, you'd make 50 to maybe some years 100% of that. But this deal was a $3 million property, and it was a 7% cap rate. So a 7% cap rate just means on your cash, what is the rent as a percentage? And so a 7% cap rate on a $3 million property was a $210,000 annual salary. And so I looked at that and thought, oh man, like, this replaces my NVR salary. And actually it better than replaces it, because $235,000 salary, you're paying 39% tax on that. This is real estate. My effective tax rate is in the teens.
That's right.
You look at expensing.
So your net, the Matthews family's personal net, even though the number, and this is relevant, I'm interrupting for this reason, it's relevant. That's why most of the stuff that I own, I take most of my profits through capital gains, which means I avoid ordinary earnings, which is way higher. And I then take cap gains earnings, which are protected, and you pay a lower rate. It's not how much you make, it's how much you keep. So the difference between those two numbers is really important.
Yeah. So great. I keep a lot more of my $210,000 of real estate rental income than I kept from my $235,000 salary. So for me, I was like, wow, this is amazing. I have a 10-year lease. I'm going to lock up a 10-year lease. So I I also needed to know, Frank, how strong is Gerber as a company?
Yep.
They're very strong. The beauty of them as a publicly traded, you don't get this with every industrial. You can't get financials that are that great. They're audited from a private company. But I had a publicly traded company that I knew was rock solid financially, because my main risk is they go bankrupt. If Gerber goes bankrupt, now my lease is void and I'm stuck with land in Hinesville and I can lose money on it. So I looked at it and I thought, wow, this one deal literally replaces my salary. I'm going to give myself a salary that comes out of this. Now I just need to figure out how to evaluate the risk. And that's something that I needed to go find help for.
So do you want to talk about your team? Is that where the team comes into play?
Yeah, sure. So I have an amazing attorney, and I got very lucky that it was on the first one. So she had worked for Peterson, which was a big land developer for NBR. So she came highly recommended by a number of people I knew from the residential space as a contract person, a brilliant one. And she has her own, her name is Amelia Elzy. She's fantastic. She has her own firm. She's had it for several years, and she's perfect for someone like me. She's gives you a lot of personal time. She's done so many leases for big companies that she's very well trained. A little bit like you, Frank, lived in the corporate space for a long time, then went on her own and brought all that institutional knowledge with her. So she's solid. And I loved her from the get-go. So a lot of attorneys are very boring. She was amazing from the get-go. She made me laugh. She's kind of crass. She's funny, but she doesn't try to run up the bill on you. And so she helped me. When you do an industrial deal, you have to do an environmental study. You have to go check permits. You have to, she's pulling plats. She's making sure that I'm entitled to all the land that is there. And we had some issues in the environmental report that came back with some tanks that were underground. So she had to help me evaluate the risk. And then you do a phase 2? These kind of things cost, an environmental study's $5,000, a good one, a good phase 2. So she helped me evaluate all the risk, because I didn't know how to do that. I needed someone to say, you have clear title, your permits are fine. No one's ever going to come tell you that you can't operate a collision center there, because that would be on me. Environmentally, you have a sound piece of property that the state's never going to shut down or do anything like that. These are all things you have to think about when you get into industrial that you don't think about in a residential property. Right. You've never done a soil sample, I'm going to guess, on a residential property in the backyard checking for PCBs.
Not for a single family, but if you buy a parcel of ground, you absolutely do a phase 1.
The big one. The big one.
Yeah. But I think the more relevant thing to talk about here is you found an attorney to have this massive team. You found someone with a little bit more knowledge than you had on the subject matter, someone who was a subject matter expert who could help you navigate pitfalls. And then we're talking about, like, Ian's got a bunch of money in the bank, but at the same time, he's spending time, he's driving down there, he's looking at it, and he's coming out of pocket during his due diligence period with, upwards of $10,000 that if he doesn't, maybe even a little more, that if he doesn't buy this, he is going to lose. But it's a hedge. It's an insurance policy. It's one of these things where if I'm going to plop down $3 million of my own money in this particular deal, the $10,000 is peanuts, because what we're trying to do here is create wealth for the Matthews family, some stability, a paycheck, and $10,000 is, less than one paycheck. So if you lose it, you lose it. But these are the things. What I've learned so many times is that people who don't have money or are reaching get desperate. And when you get desperate, you skip fundamental steps, because you're looking at, holy shit, it's 10 grand.
Yeah.
10 grand to 3 million is nothing, but 10 grand to someone who doesn't have 10 grand is a lot. So people make bad decisions up front. And then what ultimately happens is you don't have a $10,000 problem. You have a couple of $100,000 problem that you have to eradicate. And you could have gotten rid of this for a smaller fee. So you do all your due diligence, you do everything up front. Let's get into the lease. Was the lease in place? Did you have to negotiate the lease? Like how did all that work?
So the guy I told you about that already worked with Gerber and put the money into the property, he had collected maybe 1 month of rent already, and he was looking to get rid of the property because he had done a good job, and given the cap rates in the market, I think he could make $700,000-800,000 on this deal. You know, he buys it for $1 million, puts $1 million in, you know, let's just say it sells for $3 million, he nets $1 million. So he was anxious to sell. And so I was fortunate to call around to enough banks and work with him and buy the property. So I bought it with a lease in place. I had all of my studies done. So this was literally a plug and play. I needed to close. And, you know, my attorney was fantastic at helping me get through it. And I formed an LLC, this one was Hinesville Collision LLC. Jenny and I are 50-50 owners on this thing, and we funded it, and that we own it in that LLC. It started a bank account, everything else, and we wired the money. We did it. This was an all cash deal.
All right, let's do this really quickly. The first deal you did was Hinesville, Georgia. Where was the second deal?
So second deal, so we closed this in late February, Frank. So this is 60, I did all this in 60 days from leaving NVR, not exactly retiring. It was a little bit of an overachiever. And then the realtor who had worked with the guy that I was put in touch with on the first deal, the Hinesville deal, they had been involved with him, the seller, on that. And they called me 2 months later and said, we have one that we think is even better. And I was like, wow, really? And it was a industrial equipment rental company in Savannah. And we were in Spain at the time when they called us. So we were in Spain, and I bid on it. I was like, screw it. I'm going to try to get that one too, because I liked it even more. H&E is publicly traded. You know, it's a little bit different than collision centers, a little different type of deal. And I verbally was negotiating from Madrid. I remember this. I remember negotiating with him, and he said, congratulations, you got it. You know, you're gonna have to wire some money, you know, for the hand money. And I'm like, oh, that's great. And then the next day he called and said, I got outbid on it, and they decided not to sell. So it fell apart, and I was crushed. I was so pissed off because now I got the bug. You know, I've got 2 months now where I'm getting this direct deposit of $17,500 hitting on the first of the month. And I'm like, I want more of those. I want more of those direct deposits. Those are great. Make me feel more comfortable. And so when that happened, the realtor felt really bad, said, I'm really sorry. I thought they were serious. I guess they weren't. And when we got back from Spain, he called me about another collision center in Orlando. And this was the Caliber Collision. So this is the main competitor for Gerber. And this was a bigger property, but a lot of the same things, right? The building wasn't as nice, but it was Orlando. So it was a way better zip code in a growing Dr. Phillips neighborhood. And so as soon as I got back, I told Jenny's dad, I'm going down to Orlando. I'm going to go look at another property. And he was like, I'm coming. He just wanted to come hang out with me. So he got on a flight from Chicago. We went, we looked at the property. We both loved it. And, you know, I kind of left there thinking, I'm gonna make a bid on this. I'm gonna try to get this second property. This one was $3.5 million with the same cap rate, 7%. So a little bit bigger property in a little bit more expensive zip code than where we were in Georgia, but it was in the South. It was triple net. This one was a 15-year lease, which I loved. It's an even bigger lease on it, with rent increases every year, just like the first one. And so I came back and I decided, I think I'm gonna bid on this property. And right around then, so I was going to do this one myself again, try to figure out how to do this myself. And right around then, a good friend of mine who had left NVR, he's a little bit older than me, someone had told him that I had bought this collision center. Because, you know, I told some people, this is what I'm doing with my time. Everyone from NVR wanted to know what the hell's Ian up to, what's going on. So I think I was probably fascinating that Ian was in the collision center business, because I don't know shit about cars. And so,
Or how to change your oil.
I can't change my oil. I don't even know where to put the windshield wiper fluid. But I owned a collision center. So I got a call from a friend who had retired, and he said, "Hey, next deal you're doing, can I get in on it?" And I kind of said no. I'm like, well, it's not the way it works. I don't think I could do that. Let me think about it. And so I got this call. I called him after the collision center. I'm like, how would that work? It's like, I don't know. We'd go in on it on the LLC, and he's like, propose something to me. And so I was, he told me how much money he wanted to put in. It was like 350,000, something like that. And, which is 10% equity in it. And so I just jotted out some terms on an email of, what if you get in, you help me with whatever your percentage of equity is, you'll help with those closing costs. And I will keep a certain percentage of the rent and give the rest to you. For managing it, finding it, I will keep a percentage of your percentage of the rent, and that will be my management fee. And he said yes. And then by the time the math worked out, it wasn't great. And then he started to get out, but this was close to when we were closing. So I remember talking to you about it, and I was like, oh shit. And you're like, just make it work. It's your first one, whatever. If you got to take less than you probably wanted to deal with the headache, just make it work. So the way it works, Frankie, is my investors.
Explain that part of the conversation. So this happens a lot. And like I don't remember the exact conversation, but when we were talking about this, I do remember the line I said to you. As someone who's basically had a tin cup in my hand for a decade, begging people for money, what I realize is it's really hard to do it. It's uncomfortable. And if you are going to get a second allocation from somebody, you got to get a first. And there's a moment that changes in the relationship of a business when you're starting to put these things together, that you start to realize, like, okay, I'm a capital raiser now. It's a different business. So talk a little bit about that conversation. Like, talk about that conversation with me, and then what you did to get it done.
Yeah. So, I think I was just making up as I went, like trying to figure out how much of the income I would keep, how much I would give to him, how do the shares work. In conjunction, I had a separate attorney working on it, because once you bring an investor in, Frank,
everything changes.
It's now become an SEC security, so
Yep.
Regulated security. So I am now raising capital for something that's a whole nother side of regulation. And there's carve outs for friends and family, but people need to be accredited. You need to prove that. You need to build an operating agreement. You need to build a subscription agreement and a joinder agreement that ties it all together. So I had an attorney to do my first one. I probably spent $15,000, $20,000, because I knew I wanted to do a little bit more of this, and I needed one solid, my agreement, what it's going to look like every time I do this, because in conjunction with the guy I'm talking about, I ended up getting 2 other investors to come in. So it was getting to a place where I was going to be 50% owner in this deal, and they would be 50%. 2 of the investors were okay with the terms. The first one that I had, by the time he did the math, he's like, the return is just not what I want. He's like, but he's the greatest guy. He's like, look, I know this is late in the deal. What if I gave it to you in debt? He proposed like a loan, and I didn't want to do any of that. And so I told you, like, man, like a sliver of my investors is kind of falling apart last minute. So I'm figuring out, do I go sell something? What do I do? And yeah, you just said, just go make it work. Like,
Get on a plane, go see them, do what you got to do, just get it done.
Take less, to do whatever you need to do. Just make this work. And the next deal, you could always do better on it, but just learn how to have investors in a deal and do a good job for them. And that was good advice. And so I just called him and I said, what if we tweak it here? So the way the final deal structured, Frankie, I keep 15% of the rent. They get 85% of the rent. So, for me, if it's
for their portion, for their 50%, because you own 50%. So you get the rent for your 50%. But now what you've done is you've taken some of your capital off the table, you've levered it. And then what you're getting is you're getting a return, a cash-free return on the money that they brought. You're still getting 15% because you're the one who structured the deal and put the deal together. And if you want to get kind of nerdy and granular on this, there's different levels. That's like Ian's the GP, so he gets a little bit better terms because he's the one that's running the deal. And what I want to know is, why the hell did I learn this stuff until my 40s? Like these are pretty standard deals that have been going on for, probably a century or more. But this is how people with money make money. And this is where Ian brought a deal, found people who were interested in the deal, and then still took some of his money that he invested in other stuff off the table and still got a fairly nice return because he structured the deal. And you're allowed to do that. And people who are getting these kind of returns are like, yeah, that seems fair.
Well, the more we just talked about it, all the investors were like, if we can get a 6% return, we're pretty happy with that. Like,
right.
Money we don't want in the stock market. We don't want speculative. This is tied to a very good tenant and a solid lease, good piece of land. We really just want cash flow. And so, the 1585 split, that's kind of where that came from. It was a 7% cap rate. By the time I kept 15% of, it was close to $2 million that I raised for that deal. They were at a 6% return. So that's he told me that was the number he wanted to be at. I looked at it, I'm like, it's worth it for me. So the math on that is a 7% cap rate on $1 million. That's $70,000 of rent. That's $70,000 of income a year. So if I'm keeping 15% of that, that's about $10,000 a year of management fees. So I raised $2 million. So in essence, every year I made $20,000 salary on this deal just on their capital. So a lot of people ask me, why didn't you just go get debt? So I could have went and put $2 million of debt on it, but I would have paid 5% interest. I would have paid someone for that money. In this case, I raised private capital and they paid me for giving me the rest of the money to come in. So instead of paying, whatever that 5% would come out to, I instead was making $20,000 a year in management fees on it.
Yep. I literally did a webinar in my learning series 2 days ago when I talked about was finance. And people who are good at finance, there's a reason Warren Buffett's one of the richest people in the world. And there's a reason banks are some of the richest companies in the world, is because they understand that the number after the decimal point matters. It's like that scene in Office Space where they're like, oh, I guess I miscalculated. Like it really starts to add up to a point where people are going to get like real money that starts to matter. And what you figured out is it's easier than working with banks. One, these are people you want to do deals with. It gives you a reason to talk to them. And after all those things, in the end, you just added another $20,000 salary. So if you take the first deal we talked about and the second deal we talked about, you've actually exceeded your NVR pay on 2 deals, and you've not diluted yourself and all your money.
Yeah. And for the investors, they didn't have to go find the deal. They didn't have to go do all the work I did to find the deal. They didn't have to do any of the diligence, the legal, the environmental, the title, the permitting. They didn't have to deal with all the attorneys to get into it. They didn't have to do the accounting, the finances every month that I had to do, the distribution. So once a quarter, I sent them a check in a little spreadsheet, a 1-sheet spreadsheet of, here was our rent, here was our expenses, here's my management fee, here's your cut, here's the check you're getting. And I would send it for all of them, and I'd send it every quarter. And so once a quarter, you get a check for the money that you put in, and that kind of makes you feel like it's safe and it's a good deal. And so, it was on my portion of the 3.5 million, I was making 7%. On their portion, I was making 1%. So I was happy with it. For me, it was a great return. And then, when I finally decided to sell, so this was 3 years later, I decided to sell because these assets are now in high demand, and cap rates have compressed from 7 to 6%. And truthfully, I knew that the deal that you and I were talking about, that I could get a much better return on my own investment on that. And it was at a place where I could sell this thing for, 20% more than what we bought for it. So I talked to the same realtor and said, if you can get that price, do it. And I was able to give all of the investors in the deal a cash on cash return from their dividends, everything else, 21% after all of our expenses. Like someone who had, let's see, the investor I was talking about that put 350,000 in, the 10% owner, over 3 years, he made over $51,000 in quarterly distributions, and his total all-in return was close to $80,000. So, and that's on a safe asset. He wanted something that was safe. That's a pretty good return for something that, you wouldn't get that from a treasury, or, if you'd have bought AT&T because you like the fact that they had a 5% dividend, you'd be down 15% today. High dividend stocks usually suck. They usually fall.
So I think what we've kind of uncovered and talked through here is a few things, and it's probably time to take stock on what we've accomplished and then kind of summarize this thing. What I've learned in working with people with money is what they really want is they want safety, they want margin, and they want time. So with people that have enough money who are looking at a 6 or 7% return, they don't want to be, they're usually fairly reasonable, they're low maintenance, and they're people who they literally want to make sure they're going to get their money back, they're going to get their return, and it's pretty easy to work with them. Is that what you found?
I love all my investors today, and that goes for the investors that I've raised capital for Keep, that I've raised capital for you, that I've raised on these 3 industrial deals that are in those deals. I love all of them, and I can say that I'm a little spoiled in that I've only chosen people that I know and that I knew wouldn't be freaking out, and I don't like to take money from people when I know it's a big chunk of their net worth.
That's right.
So because they'll be nervous, and I don't want any of that. I don't want someone to feel stressed or nervous. So I've not raised so much money to the point where I'm out taking money from people I don't know too well, or at least don't know. I've only taken really money from people that I know, or they can vouch for someone that they can handle that. That accredited investor thing is a pretty big deal. At least, and I would say it's skimpy. Most people that are in these deals are blow away an accredited investor, what the definition is. So it's good to have investors that aren't stressing out about their money all the time and calling and bothering you about it.
So we're running a little long on this. So what I think we should do is kind of work towards a wrap. I'm going to ask a couple of quick questions, and I think it'll get us there. To manage the property, how hard was it for you to manage the property?
Almost no work.
To put this in perspective, I own 300 plus houses. It is insanely hard to manage these properties. Ian used to text me kind of gloating. He'd be on his Peloton in his basement, and he's like, "Hey, I just did my property management for the month. I opened the app on my phone for Bank of America, and I got my wire." And that was his management. So picking what you want to pick is something that's incredibly smart, because you have to look at, like, what am I going to get back for this? I make better than a 7% return, but I got to break my ass to get it. Ian was like, I want to coach baseball. I quit a grinding job to not have to do that. And it was very purposeful. Talk to me about inflation.
So, the best way to fight inflation is just to own hard assets. And these leases are really built. So 2 of my leases are built where the rent increases with CPI every year. So I just got one back for—
Define CPI. What's CPI?
CPI is the Consumer Price Index. So all that is a government measuring stick for how much a basket of goods, the prices of a basket of goods that they've defined, rose over the past year. So that's all inflation is how much is milk more expensive? Is steak more? You put it all together, That's CPI.
Let me explain it just quickly for people who don't know what CPI is. It's kind of like a benchmark. There's benchmarks with mortgages. Most people are most familiar with like a floating mortgage. It's tied to like a LIBOR or some kind of an interest rate that has a float. That's what it is. But what it does for Ian is it helps him hedge against inflation, because as the price of milk and bread goes up, so too does his rent.
So my rent goes up every year based on CPI. So I just got a spreadsheet a few days ago. With one of these properties, my rent went up 5%. So it was like $540. So I get a raise every year. So long as inflation is going up, I'm protected with my income. So it's not like my cash is getting eaten away.
What I love about that is this. So because his rent goes up every year, my rent goes up every year too. Mine's not as sophisticated. It's not tied to CPIs, but they go up year over year. So if you take your money and you park it in something, if you buy a stock, it can go up, it can go down. When you buy real estate, you get depreciation, you get all kinds of other cool stuff. You get to go to Disney for free twice a year because you can travel and go see the property. But the other thing that starts to happen is hard assets appreciate. So there's appreciation in the actual unit. The building is worth more because the cost of materials goes up, the cost of milk goes up, it all kind of goes with it. And the rents go up. So as Ian would have been at NVR and he would have gotten a 3 to 5% annual raise, he's getting a 3 to 5% annual raise now through his rents. So if his goal was to replace his income, he's replacing his income, and he's also not really feeling any poorer year over year because he's also getting raises.
Yep. There's big tax benefits from the whole thing. And, when you ask about how much time I've spent, I've not been to the H&E property since we closed. I've been to the Gerber property once since we've closed, and that was really just to show IJ the property. We drove down somewhere down to Georgia, and I've been to Orlando a couple of times, and the reason why is I go to spring training with IJ. So when we're there, we go look at the collision center and, make sure we go shake the hand of the landlord so that I can make it a legit business expense that I was down in Orlando.
Exactly. Do you listen to Charlie Daniels when you go to Georgia?
No.
So I think the last question we ask is, would you do this type of a deal again?
Oh yeah, all day long. I mean, for me personally, just to give you the economics of the Orlando deal, for me personally, because I keep a chunk of the management fee, and also I get 25% of everybody's of all the investors, whatever equity they made on the sale, on the disposition. So that they keep 75% of the profits on the sale. I keep 25% of their profits. Same way I keep 15% of their rent. So our investors made 21%. I made closer to 35%. So on my investment of $1.7 million, I was close to 570,000 of that. Includes rent, that includes appreciation, that includes management fees and holdback. So for me, it was an outrageously profitable deal for the safety, right? Because if you think about it, I bought a boring collision center with a 7 cap rate, and I still made a 35% return on that much cash. I would do this deal 1,000 times over. There's not many deals you can find that can give you that kind of safety with that kind of upside. This was my first syndication. This is a syndication just means you acquire an asset using some pool of other people's money and yours. So as a syndication, my first one, it couldn't have gone better for investors and for myself. So yeah, hell yeah, I would do it 100 times over.
So for those of you that listen, I'm a young dad. I'm an old person, but I'm a young dad. I got a 2.5-year-old and a 3-month-old at this point. And what I think about is what I'm going to teach my kids and all the fundamental stuffs, right? And I don't know if I mentioned it here, but I mentioned it to Ian in private. Like I had this guy, he's like, when are you going to teach your son real estate? I'm like, well, after I teach him how to ride a bike and hit a baseball and climb a tree and, how to throw a water balloon, like when he's old enough. But the point of the matter is for people who are in the inside, there are incredible deals like these that are hiding in plain sight all around you. What I would tell you is if this is something that's intriguing for you, reach out to people in your market, or people that you know who own real estate and talk to them about it. People are always looking for investors who have a little bit of money that would be interested in putting in a deal like this. And ultimately, it's a learning experience. If you work with someone like Ian and me, which we're working on our second deal now, we write a paragraph or two every quarter so you understand what's happening. We give you information so you can learn off it. You can be informed. And this is a really good way to grow your wealth as you save it. Instead of it sitting in a checking account doing nothing, you can find safe investments that give you depreciation benefit, that give you all kinds of benefit that owning a stock does not. And if you do it right and you kind of stack them over time, you do this for 20 or 30 years, your life is going to look insanely different. If you do it the right way, you get money from your business and then you get that money and invest it the right way into the right assets.
I think also from this perspective, Frank, having you and I haven't gone through the residential cycle with COVID, I think it's important to note, I collected 100% of my rent through the entire COVID on all of my properties.
And that was interesting. Let's bring that up since you thought about it. You sent me an email that Gerber sent you an email, like as soon as COVID hit and they asked you for rent relief essentially. And you said, no, you and your attorney went back and forth. And ultimately it was almost like Gerber's so well run. They said, here's an opportunity to potentially make a little bit more money. And they kind of asked you for a reduction.
So let me tell you how this went. So Caliber was the first to reach out to me. This was probably in like late April. They sent letters sent letters to everybody, all of their landlords across the whole country, saying it's pretty tough out here, right? Like people aren't driving, they're not going to work, less collisions, we're struggling. We would like to propose to you that if you could do some rent abatement, which is just, could you accept less and we will pay it all back. So for 4 months, get us through this and we will pay it all back next year. So I went back and forth with my attorney and I thought, that's fair. Like this sucks. If I can help them, I don't want them to go out of business. I'm not going to miss a mortgage payment by giving them, collecting 25% less rent for the next 4 months, and I'm going to get it all back next year. Okay. Then H&E reached out to me and they proposed something even a little different. They asked if I could accept 10% less rent, but they gave me 2 years on my lease, 2 years of extra lease.
They added to the lease.
To me, it was awesome. I was like, yes, because I want to hold that forever. So yeah, let's negotiate that. And then Gerber doesn't reach out till like July. And now like the economy's already hot and they reach out right after they release their results. So, I'm on all their investor relations updates. I read every press release that Gerber does. They had just announced like this bonanza profit quarter. And then they send me a letter saying, times are tough out here. We're only collected 60% of our rent. And, we were hoping you could stand shoulder to shoulder with us. And that was the one where I was like, screw off. Like, I just saw your report. So they sent that to me and I was like, no, I'm good. You just can go ahead and pay based on your lease. And that was it. And then this guy calls me from their corporate office. He's like, hey, he's this good old boy from, wherever he was, down in Texas or something. He's like, hey, I'm trying to understand your stance on this. We got a lot of landlords that are trying to help us out here. And I'm like, I read your report. You guys are swimming in profits. And he's like, we're trying to get guys to stand shoulder to shoulder. I'm like, quit saying that. I'm some dude in Vienna, Virginia. You're $1 billion company. Like, we are not standing shoulder to shoulder. I don't come up to your ankle. I'm like, pay me based on my, like, what was cool was at the beginning, I was like, what can I do? Are they gonna sue me? I was so nervous. But by the end of COVID, like you and I have been through the resi, I was a little more hardened where I was kind of like, screw you. And my attorney was great. She was like, this is why we negotiate leases, Ian. This is why we don't do deals with bad leases. Your lease says, show me you're bankrupt and then I'll give you some money off, but they owe you all of it. So just tell them you owe me the money. And I did. And the guy argued with me a little on the phone, never heard from him again. Didn't give him any abatement, didn't drop my price, didn't do anything. I got all of it.
You got a phone call from Gerber's Michael Clayton.
Yes, pretty much that's what happened, but he sucked and I crushed on him. But what was great, so, And he was trying to get me to negotiate down. He's like, look, we can't not do this for you because what will all the others think? And I go, well, based on your, line of thinking there, I haven't given this deal to all of my tenants. So what am I going to tell them if I gave Gerber a sweetheart deal? And then he just paused. He didn't know what to say. I'm like, so I'm using your same logic. I can't do it because I didn't do it for everyone else. That's going to be your point here. And that was it. And then it went away. Caliber ended up paying me everything back by August. So things got better. They were supposed to pay me all this year. They paid it all back in August. And with H&E, I ended up with 2 more years. So all of my properties, I got everything I wanted. And I told Clear Channel, I have a billboard with Clear Channel. I just told them to go to hell. It's only $200 a month. I don't have the time to talk to you.
This is why a guy who can't change his own oil buys collision shops.
That's true. That's true.
Ian,
Well,
I think this was a great podcast.
Hey, thanks, Frank.
It was brief and succinct like all of ours. And I think it's time we let the loyal listeners go on with their day.
Fantastic. Great talking to you, dude.
Always a pleasure.
You have a great Friday.
You too.